Welcome to What the is going on with the economy, the #1 personal finance and economics newsletter for people living abroad, powered by Abroadin. I'm your host, Elliot Locke. Let's get into this week's episode. Welcome again. This week, we're taking a look at what happened with the dollar, why gold and silver fell, our Industry Season 4 Episode 3 Financial Terms recap, and we have your replay of last week's live edition of the newsletter. Let's get to it. But first, can European budgeting apps sell your personal financial data? We came across a Reddit post about personal budgeting apps and our financial data that got our attention. The person laid out a case that many popular budgeting apps are selling their customers' personal financial data to third parties. For European residents, and this was on a subreddit dedicated to personal finance in Europe, this represents a grave violation of our private rights per GDPR. So why are we writing about this? First, this person did raise some valid points about some of the tools mentioned, including those based in the US, where data privacy rules are different than over on this side of the world. Second, the person lists the use of third-party aggregators, Plaid, Yodlee, Finicity, that access your banking data as a violation of our GDPR rights. However, this isn't correct, and it's important to understand why as more and more financial institutions, including traditional banks, are offering these services. Here in the EU, the sharing of personal financial data isn't covered by GDPR. Instead, a separate, more powerful regulation called the Second Payment Services Directive, or PSD2, governs how and who we can share our personal financial data with. In short, PSD2 requires that all banks and financial institutions let their customers share their data with others on their consent. This is crucial. This is at the core of what's called the open banking movement. Let's take an example from last week's newsletter where we talked about how credit scores work in France. If you recall, French lenders can ask borrowers to share their bank account history so they can make a better risk assessment. PSD2 allows the potential borrower to do exactly that, send their banking data to the lender. However, the lender can't access that information directly. Instead, they need to go through a third-party provider that holds a specialized license from a financial regulator. This third-party provider is called an Account Information Services Provider, or AISP, which acts as the secure operator between a customer's bank where their data is stored and the company on the other end that processes with the customer's consent. All of this moves through APIs. Think of these as transmission lines between servers and software. Neither the bank nor the AISP can share that data with anyone without the customer's explicit consent, which the customer gives to the company they want to share it with. That company also has strict rules on how they can store and process that information, and unless they get their customer's authorization to do so, they cannot freely share it with another party. We can bag on the EU all we like for being too eager to regulate, and some of that is deserved. However, PSD2 is a brilliant piece of legislation that created a secure environment for financial innovation. In fact, the US doesn't have anything similar. The Biden administration initiated a rule change, but the big banks protested, as there's a lot of value in personal financial data. The Trump administration subsequently dropped it, maintaining the regulatory gray space that's hard to innovate in. So to go back to this person's post, yes, you should be mindful of sharing your personal data with companies in the US. However, here in Europe, there's far more security. If you ever come across a budgeting platform here, quickly check their third-party provider. Chances are they're a regulated firm here in the EU, keeping your data secure. Now, let's get to the big question looming over the internet. What happened with the dollar last week? For all you dollar watchers out there, your heart, and maybe your liver, went through a lot last week as the Greenback dropped to lows not seen since 2021 before pulling back a bit in time for the weekend. There was understandably a lot of noise about the dollar, particularly for those earning them, but living in the Eurozone. Here's what happened, what you need to know, and why perspective will keep you from panicking. First, let's look at why the dollar plunged in the first place. There are a few factors that caused the dollar to drop last week. Donald Trump's tariff talks strikes again. Mr. Trump came out in the middle of the week with tariffs back on his agenda. This time, he threatened both South Korea and Canada with more duties. In the case of South Korea, he was allegedly trying to accelerate a new trade deal. With Canada, Mr. Trump took offense to PM Carney's remarks at Davos along with his rapprochement with China. Whenever Trump makes these threats, the markets get startled. Then, the yen carry trade might be unwinding. We wrote about it last week, but the Japanese yen carry trade might be near its end. Japanese investors are more willing to sell their US treasuries than take the dollars and buy yen with it, while foreign holders of Japanese government debt would go the other way. This could create chaos for the exchange rate as trillions of dollars between the two currencies rapidly change hands. Last week, the US government hinted that they could help the Bank of Japan intervene in the currency markets to support the yen. This also frightened currency traders who saw this as weakening the dollar. Finally, U.S. interest rates remain unchanged with concerns about future uncertainty. The U.S. Federal Reserve met last week and kept interest rates unchanged, and will likely keep it that way for the foreseeable future. Interest rates are actually the biggest driver of exchange rates, as it's the outlook of that underlying economy's performance. Currency traders didn't see a lot of confidence in the U.S. from this meeting, which meant investors sold dollars for other currencies, like the euro. All of these factors combined to scare many international investors and chase them towards other currencies they see as safer, like the euro. By Wednesday evening, €1 bought $1.2016, or inversely, $1 bought just €0.8322, causing Americans in Europe and remote workers earning dollars to scream out in panic. Next, let's look at why the dollar bounced back. By the end of the week, the euro-dollar exchange rate finished at 1.1854, still not great, but better than its peak. Here's why it recovered. Currency markets tend to bounce back quickly after Trump's tariff proclamations. Trump creates a lot of volatility in markets. However, that volatility is short-lived as Trump either tends to reverse course, the taco effect, or the markets realize there's no practical enforcement mechanism for whatever idea he had. We saw this once again play out. Second, a potential new Fed chairman calmed markets. On Friday, President Trump announced that Kevin Warsh is his nomination for the next Federal Reserve chair. Markets reacted positively to this pick, as Mr. Warsh is seen as someone who is largely qualified for the role. This gave investors and currency traders confidence that the Fed will still have some independence and will help manage the U.S. economy prudently. Lastly, commodities traders took profit, leading to a big sell-off. Another big story, and we'll likely cover this more next week, is that the gold and silver rally suddenly reversed on Friday. There are a couple of different reasons for this. However, the two main drivers were Warsh's nomination and investors taking their profits following a historic bull run. As investors sold their gold and silver, they received dollars. This increased demand for the Greenback, which supported the dollar in currency markets. Before you reach for the nearest bottle of strong alcohol, here's why it's not worth panicking over just yet. There was tons to freak out about, but as always, there are reasons to remain calm. The euro-dollar exchange rate is actually right at its historical average, sitting around 1.20 euro-dollar. The past 2 years have been an outlier with the dollar stronger than normal. It was great while it lasted, but it was the exception, not the rule. This can always change, but we'd need to see a major shift in the dynamic between the two currencies before that happens. Plus, a strong euro is actually bad for the EU, especially if it strengthens quickly. Europe is still a major goods exporter, even more so than the US. If the euro is too strong, it makes European exports uncompetitive. There's talk that the European Central Bank could also intervene in the market by selling euros to weaken the currency. Currencies are binary. If one side of the pair goes up, the other must go down. The European economy is still largely treading water and is looking a bit lost in a world where the geopolitical rules are getting rewritten in real time. Until Europe has more direction or looks like a viable alternative to the US, there's not a whole lot of room for it to grow. Most importantly, the dollar isn't finished as a reserve currency. A lot of the chatter I saw was about how the dollar was finished and there was debasement going on. We don't really buy that, as first, there isn't a good replacement to the dollar, and second, a mass sell-off of US treasuries by global investors almost certainly won't materialize. This goes under the radar, but US treasuries play a crucial role in the global financial system as collateral for other investments and financing. Even if some investors sold their treasuries, others will quickly buy them. The bigger concern for the US is for future borrowing. If investors lose their faith in America, it will cost more for the country to borrow. That's probably the bigger risk right now, but it hasn't materialized as of yet. What you can do to stay calm. These times aren't a lot of fun for anyone exposed to the exchange rate. There are a couple of things we suggest doing to keep your sanity during these times. Currency markets are outside of your control. There's zero way to beat them. The best guaranteed exchange rate you'll get is the one you get right now. If you need to convert to cover your fixed costs for next week, it could be wise to do it sooner rather than later. Plan as if the dollar will weaken further when doing your budget. I know it sucks as you'll have less spending money, but it will allow you to live within your means. If the dollar strengthens, then you'll have some extra cash to plan with. Keep your currency management strategy simple to avoid costly mistakes. As I was reading comments in different forums and groups, I kept seeing commenters talk about their fancy currency management strategies to help avoid the exchange rate. Many of these involved complex hedging strategies like going long one side of the currency pair and short the other using derivatives. I often had a hard time understanding what these folks were trying to do, which made me think they didn't fully understand it either. As a rule of thumb, the more complex your financial strategy, the more risk you'll take on. Unless you have some airtight way of mitigating these risks and the appetite to absorb big losses, the more dangerous it will be for you. Keep it simple. If you're really pressed and have the possibility, for example, if you're a freelancer, try to pick up work that pays in euros. I know that's far easier said than done, but diversifying your income stream can help smooth out currency risks. Now for our Industry Season 4, Episode 3 Financial Terms Recap. Unlike the previous episode, this week's edition of Industry laid on the financial terms thick. The plot moved away from character study and back into the plumbing of the digital economy. We identified 3 critical concepts that define the risks and rewards of the fintech world. 1. Jurisdictional washing. Tender is currently under suspicion for what the characters call jurisdictional washing. This is the practice of running payments through offshore markets, where regulations are relaxed to clean transactions that might otherwise be flagged as suspicious or illicit. This process effectively mirrors the 3 legal stages of money laundering. It starts with placement, where the money enters the system. It moves to layering, where complex transactions are used to hide the source of the funds. Finally, there is integration, where the money appears legitimate on a balance sheet. For the international community, this is a reminder that while relaxed regulations might mean a smoother app experience, they often hide significant systemic risks. 2. Banking licenses and the Brexit gap. Tender's primary goal in this episode is to acquire IBN Bauer, a 300-year-old Austrian bank. They are not buying the bank for its history, but for its banking license. Getting a full license from scratch in Europe can take years and cost millions in legal fees. Buying an existing bank is the fast track to becoming a regulated institution. However, the episode highlights a major hurdle for the international community. While an Austrian license allows a firm to passport services across the EU, those rights no longer apply to the United Kingdom. Since Brexit, EU banking licenses are not valid in the UK. This is why many of the apps you use have different legal entities and protections depending on whether you are in London or Berlin. 3. First loss arrangement. To close a deal with skeptical investors, Eric Tao agrees to a first loss arrangement. This is a high-stakes, skin-in-the-game agreement where the manager uses their own capital to cover any initial losses before the other investors lose a single cent. In this case, Eric pledges his own money to cover the first 10% of any downside. This is an extreme way to build trust, but it carries immense personal risk. You will almost only see this arrangement with professional or qualified investors. If any business venture or investment scheme offers a first loss guarantee for your personal savings, you should consider it a major red flag. We'll be back tomorrow with the financial terms recap from tonight's episode on our Instagram and LinkedIn pages, so be sure to give us a follow there to stay up to speed. Wrapping up with some abroad news. First, a replay of last week's live version of our newsletter. In case you missed it, we had our first live version of our newsletter last Wednesday, and it was a fun one. In it, myself and our other financial expert, Niels McAvoy, took a deep dive into the 2026 economy, analyzing key financial indicators like the P/E ratio, the US dollar's role, and geopolitical factors like the Trump factor. We also went over some of our favorite tips on diversification, maintaining a cash reserve, and adopting a long-term, rational perspective for investment decisions despite tons of noise. You can check out the replay at the link in our show notes. Last, we're keeping the workshops coming and are gearing up for our next one in a couple of weeks. However, we need your help. Help us decide which one we should do next. We're split between 2 great topics for our next workshop: how to quickly get on top of your accounts and finances spread around the world, or mastering multi-currency budgeting. Help us decide which one we do first by voting in the quick poll link you'll find in the show notes. That's it for this week's edition. Thank you for joining us. Thank you also to our sponsor, Abroadin. If you like what you heard, be sure to subscribe so you never miss out on all of our updates. From the entire team, I wish you a good one, wherever you may call home.